Yeah, give me a quick confirmation on chat if you guys are able to hear me, see me, and see the screen properly. Right? Okay, we're going to be starting out with the session now. This session is basically the first chapter of your equity book, Equity Valuation Application and Process. And this chapter is basically the base for your CFA Level 2 equity book. Okay, the basic questions, why we are reading equity, what are the basic parts of the equity model. We are going to be looking at those concepts in this content. Okay, I'll be using the textbook and I'll be walking you through the entire content of the textbook. Okay, and will also be doing few sums at the end of the chapter. Okay, so we first are moving towards the learning objective 24.A, and over here we're going to be focusing on the core concept, the reason why we are getting into this book and why we are doing this chapter, the intrinsic value. Okay, the reason is, suppose if I want to identify the equity, the price of the equity, I should first be able to identify the factors which impact the price. Then on the basis of those factors, I should be able to calculate the true value, that is generally called as the intrinsic value of that asset. Okay, and once you have the intrinsic value, you will compare it with the market price, and based on the market price, you will decide whether you want to buy or you want to sell that particular equity. Okay, so this first learning objective is giving you an introduction to that intrinsic value, and also it is talking about what are the sources of mispricing. That means when you look at the market price, when you look at the intrinsic value, many a times you find that the market price is different than the intrinsic value, and what are the reason for that difference. That is what the learning objective is going to be focused on. Okay, so let us start with the first paragraph. The first paragraph is giving you an idea that when you try to create a equity model, okay, if I want to calculate the price of a Yes Bank stock, or for example an ITC stock, that entire process itself is a cumbersome process, because the reason is we'll have to run a model, we'll have to take all the cash flows which is going to come in that asset, we'll have to project that cash flows over a period of time, then take the present value of that cash flow. That is one method of doing the valuation. Okay, so since there are many approaches, many methods available, each method has its own pros and cons, and it might be difficult for an analyst to freeze out on a single method to identify the valuation of that equity. Read that first part. Read that first part. So whenever you are looking out at the valuation of the security, the method that is used becomes very, very important. Read the first paragraph, guys. Let us go to the second paragraph. Now, in that second paragraph, we are talking about what exactly is the intrinsic value. Intrinsic value, in a layman's term, is somebody who is well aware about that asset. He knows the risk of the asset, he knows the cash flow of the asset, and on the basis of that, he is able to identify the true value of that asset. Okay, that is nothing but your intrinsic value. Okay, read the first 3 lines and mark this first 3 lines as star. And I'll keep on telling you which all component is important when you go through the content and read. That component I'll be highlighting it. Okay, read that first 3 lines. The basic definition of intrinsic value has to be clear. Then what is the last 2 lines? Last 2 lines primarily focuses on, right, if the information in the market, okay, is not proper, it's not perfectly efficient, then what is going to happen? We see the market price of that asset and the intrinsic price of that asset, there is a deviation, and that is where the opportunity lies. Because if the market price and intrinsic value actually matches, then there is no opportunity for you to either take position of buy or sell. Read that last 2 lines of the paragraph. Last 2 lines of the paragraph. Simple. So you have completed the first 2 paragraphs. Let us move towards the next section. Okay, next section. Now over here, they have tried to summarize the entire issue, where exactly the problem might lie. Okay, where exactly the problem might lie. So that is being covered in that last paragraph, and the formula, kindly mark this formula as star. Okay, let us go towards that topic. Okay, now when an analyst is analyzing a stock or basically an equity, okay, the analyst primary responsibility is to go and find the intrinsic value and identify, okay, there is a difference between the intrinsic value and the market price. But the next step is also very critical, to question and try to understand why this difference is coming. Because if there is no logical explanation of this difference, then you might have done an incorrect assessment. That is why the second step also becomes very, very important. So in this paragraph, they have identified two sources of difference that you generally find, okay, between your price and your intrinsic value that you have calculated and the market price. First, let us read this entire paragraph. Let us read this entire paragraph. They have identified two sources of reasons why there is a difference between your intrinsic value and the market price of that security. Simple. Kindly read that entire paragraph properly. And in that, they have, when we are talking about two different sources, they have also given them a name. First is the actual mispricing, and second is basically the valuation error. Actual mispricing and the valuation error. Okay. Fairly simple. Now, let me give you some number. Okay. If suppose you see a market price, okay, of the security as $100. Market price of the security is $100. Just a second. One second. The market price of the security is $100. I'm writing it as market price. Okay. And you calculated an intrinsic value of your own. So I am highlighting it as intrinsic value of the analyst. Let us assume that number was $70. Okay, let us assume that number is $70. Okay, now this is you want to find the actual difference between these two part, the $30 difference. That was a error that happened. Okay, but in reality, this error can be explained into two parts. Okay, suppose if I am taking an hypothetical number, if $90 is the actual intrinsic value. Okay, $90 is the actual intrinsic value. Then this part, which was the major issue, this was the valuation, this was the actual error, right? Actual mispricing is there. With that, $90 is the intrinsic value of actual intrinsic value of that asset, taking into consideration of all the factors, and $100 is the market price. So the difference of $10 is where the actual deviation is. But since you are creating a model on the basis of your own understanding, you have calculated an intrinsic value of 70, which is different than the actual intrinsic value. This is where you have done a valuation error. This is what you have done, an valuation error. Right? So this is what the formula is basically talking about, that the entire difference of $30 that we see is actually coming in two parts. The first part, the difference of $10, that is where the actual deviation lies, and the second part of $20, that is where you made a mistake. You could not identify the actual value, okay, and you made a valuation error. Simple. So that is what is being covered with this paragraph. So it is summarizing that the actual difference of $30, it is coming in two parts. The first part is a $10 difference, which is called as actual mispricing, and the second part is a $20 difference, which is nothing but the valuation error. Fairly simple. Okay. Now the reason they're focusing more on this valuation error and this formula, because there's good chance that they might ask you a question related to this formula. So mark this formula as star, and you should be able to identify the two factors properly. Let us start moving towards the second learning objective. Explain the going concern assumption contrast to going concern value at a liquidation level. Now, what is going concern assumption? So whenever we run an organization, we term it as a going concern. The reason being, we don't know when it will liquidate. Ideally, hypothetically, that company should run till infinity. Okay, obviously there can be some factors which can lead to the bankruptcy of that company. That's a different thing. But right now when you start with an intention to run that company for till infinity. That is why we call it as a going concern. Okay, so if the business is basically running, you call it as a going concern. If the business is actually about to get liquidated or about to get shut down, then we call it as a gone concern basically. Okay, so read this first two lines. It talks about the going concern assumption and going out of business. Going out of business means gone concern. Perfect. First two lines. Right, so now whatever valuation model that we are going to be looking out in the future, our basic assumption is going to be a going concern assumption. That means, suppose if I am valuing a stock and I am taking into consideration next 15 years cash flow, next all the future cash flow, so I am going to assume that the company is going to run for that period of time, or else my valuation model will not, I will not be able to create a valuation model. Okay, that is why our first assumption that we are reading about on this chapter is a going concern assumption, which is a base of my entire valuation exercise, that the company is going to survive for a longer period of time, and that's the reason I'm calculating the present value of all the income, all the cash flow, and I'm trying to find the intrinsic value of that asset. Okay, now they have also highlighted a situation which is called as liquidation value. Now liquidation value is basically the value of the organization when the company is about to get bankrupted. Okay, that is where you actually calculate the value of selling that asset. Okay, immediately selling that means liquidating the asset. Now the only thing is that this liquidation will only and only come when the asset, the company is about to be closed. Okay, you do not foresee the company to be run for a future. That is why the valuation and list liquidation value will be lower than the actual value in the market. Okay, so read this paragraph, the entire section which is highlighted on the screen. Right, so liquidation value of an asset is when you sell that asset and you want to completely go away with that asset. When I'm talking about the company, what primarily I'll be doing is when I want to calculate the liquidation value of the company, I will take into consideration all the liabilities of the companies. Okay, and after paying all the liability, what is the net amount that is left with the company? That is generally called as the liquidation value of the company. Simple. So we have completed this smaller learning objective. The reason the learning objective was added because it wanted to give you that assumption, going concern assumption, because without that you cannot create a model. Let us go towards the next section. Over here we're going to be reading about values in detail. There are going to be so many values which we can calculate. Why are we only focusing on intrinsic value? There can be other values also, right? So that is what is been highlighted in this learning objective. Starting now, let us have a look at this section. Okay, it talks about fair market value. Which is basically when you go and try to sell an asset in the market, this is the fair value that you should be getting in the market. This is what as per today you should be getting the value. And this, when you calculate this fair value, this is basically you're assuming that the buyer and seller both are informed about the market. Okay, and they are doing the sale of the asset. So this is the price that they should come up with. Okay, this again, the fair value point will come in your FRA book, where you will do when you do the valuation of equities, when you do the valuation of other asset, you will use this fair value argument over there also. Read the first 5 lines which is highlighted on the screen. First 5 lines. Fair market value. If I go and want to buy an asset right now in the market, what is today's price? What is the normal price that I should get for that asset? That is a fair market value. Okay. Now, if the company's market price should ideally be close to the fair market price, ideally, but not necessary that this will always be the case. That not necessary, because what happens is that when you try to sell a company, the buyer will ideally try to assess what is the company's management, what is the company's future growth, and they would try to assess. On the basis of that, they will try to come up with a price. That might not always be the fair price of that company. Let us have a look at this paragraph. A company's market price should reflect its fair market price over time if the market has confidence that the company's management is acting in the interest of the equity investor. Now, why this part has been added? See, if I don't trust a particular company, okay, because of the management being not transparent, if the management has done some previous mistakes, so whenever I want to purchase that asset, I would think twice, and instead of paying a normal fair price, I might pay a lower amount because I'm taking an extra risk. And that risk is coming because of the management not having transparency. This is very simple. If tomorrow you want to buy something of Kingfisher or UB Group, you'll be cautious. You might not pay 100 rupees for the same. Instead of that, you might pay a lower amount, right? So you will not pay the fair value. That is what you have to understand. Okay. So this is where we completed the first paragraph. Let us talk about, in case of any queries, guys, can you kindly put it on the chat section? We'll try to address it as soon as possible. Let us go towards the investment value. Now, what is an investment value? Investment value primarily means that somebody who has an intention of doing an investment in an asset. So for example, you already have a house in Mumbai. You go and you are buying a house in a hill station. That is an investment purpose. So your thought process is going to be very different, right? So when you are doing an investment into an asset, you would primarily look at synergies. You will primarily try to understand certain other factors which are specific to your need. Okay, if you're buying a particular company, you would try to understand how it will help my existing company, right? So that is where the investment value comes into picture, because this value may not be necessarily matching the fair market value. I'll give you a very simple example. If tomorrow you realize that there is a company, okay, which you want to buy, if you buy this company, your existing company will be able to accommodate that new company, and you'll find very high benefit out of that, right? If you find that the market price is $100 million, you might be willing to pay $120 million also, because as per you, the synergy is very high of getting that company. The benefit is very high. Okay, even though the fair market value is 100, you might be willing to pay extra also, because that is as per your understanding, that is as per your calculation, the right price that I can pay. That is the investment value. Simple. Read this 3-line, guys. The word synergies means connection with the previous purchase. Fairly simple. Let us go to the next part. When you are valuing a company, obviously you should be aware about the purpose of the valuation. Am I valuing it only to make a small purchase? Okay. Am I valuing the company to understand the price of the equity, to purchase a controlling interest in the company? Okay. So all of this will make a big difference in terms of the pricing that you might quote to the asset. Simple. If you want to purchase, if you wish to get the major equity portion of the company, then you might be willing to pay something extra also. That is also fine with you. Okay, so it depends upon your purpose of you're calculating. Okay, if the purpose is very simple and straightforward, and you see the benefit also very high, you might be willing to pay extra also. Read this part, the last paragraph. In that paragraph, what it generally talks about, for normal investment purposes, intrinsic value works well. But for when you're acquiring a company, that is a strategic investment that you're making. Hence, the investment value comes into picture. Right? Mark this last paragraph as star. You can expect a question asking about which value you should take. Either an investment value or the intrinsic value. Simple. The next learning objective. I'm moving towards the next learning objective. Describe application of equity valuation. Now, what does it primarily talks about? When you are valuing equity, what all benefit it gives you. Okay. See, first and the foremost benefit is very, very straightforward, because based on the intrinsic value calculation, you can identify the fundamental value of an asset. Basis that you can decide, oh, if the market price is very high, this asset is very highly priced as compared to the intrinsic value. Okay, simple, right? If you realize that the market price is 100, and the intrinsic value is 90, market price is 100, intrinsic value 90, you realize that okay, this is very high as compared to the intrinsic value. True value is only 90. But suppose if the same asset is selling at 80, right, selling at 80, you realize okay, the actual value should have been 90, but right now it is selling at 80, I will buy it. So you can take that decision on the base. That is a very, very core thing that you will do, obviously, because of the valuation logic. But there can be some other factors which can be there, right? If you want to compare the asset, also you will do intrinsic value. If you have two asset, asset A and asset B, then also you will try to find, okay, what is the intrinsic value of this first asset? Suppose it is 100. What is the intrinsic value of this asset? 90, right? So that you can make some comparison between these two companies. That is why also you calculate the intrinsic value, right? Read the first two bullet points which is highlighted over here. First two bullet points. All good? Now, perfect. So basically the first model is basically to identify the fundamental value. The second model was to compare between the asset. That is the reason we go and do the equity valuation process. Now, let us talk about the steps that is generally used in the equity valuation process. The first step is to understand the business. Okay. Second, understand the business means if you know what is the true nature of the business, how exactly the company is selling the product, what is the service that they are providing, okay, who all are the customer base of the company, okay, what is the product that the company is selling, is it a necessary product or is it a luxury product? So you will try to understand what is the nature of the business. Second is you will try to calculate the company's performance over a period of time. That means you will forecast. You will take some historical data for 4-5 years, and then you will create on an Excel, try to create the forecast of the cash flow, of the income statement, balance sheet, everything. Okay. Based on that, okay, once you got the entire data, you will then use an valuation model, which we are going to be reading in this book in detail. Okay. Then you will go and find the valuation model which has to be used to come up with the intrinsic value. Okay. Then in that valuation, whatever forecasting that you have done, you're going to be using that forecasting. You will do the discounting and all of that, whatever process that has been there. You will come up with the intrinsic value, and then finally you will use that logic. Once you have got the intrinsic value, you will use that logic whether you want to buy this asset or whether you want to sell this asset. If the market price is very high, okay, as compared to the intrinsic value, you will sell the asset because it's very pricey. If the market price is low, you will buy the asset. Simple. Now in that entire step, we're going to be reading few more pointers. The first is stock selection. Stock selection. Okay. Read this paragraph. It talks about, yes, it talks about when you're trying to do the valuation of equity. Okay. You want to understand why are you doing this valuation. Either you want to purchase it, either you want to sell it, either you want to hold the security, right? And this assumption or this understanding will come when you see the intrinsic value, you compare it with the market price, and based on that you take a decision. Read that paragraph. All good. Stock selection. These are all sub parts of the 5 pointers that we talked about. Read the market. Read the market. Now think about this. When you look at the market price of a stock, okay, now this market price is based on the demand and supply, based on the market mood, market perception, okay, but the true fundamentals of the business might be very different. Okay, so how do you come to know the difference between what is market is looking at and what should actually be? That is only possible when you have the intrinsic value of the company, and then you can compare it with the market and try to understand what is the deviation and what is the logic of the deviation. If you want to read the market, if the market is very optimistic or if the market is very pessimistic, you can come to know only when you have the intrinsic value with you, and then you can look at the compare it with the market price. I'll give you an example. If the intrinsic value is 100 and the market price is 150, that means the market is very optimistic regarding the stock. Because even though the intrinsic value is 100, the market is valuing it at a higher price. Similarly, if the market price is 70 and the intrinsic value is 100, you might feel that it is very pessimistic. Market does not feel good about this stock. Okay, read this paragraph. All good? Reading the market. Reading the market. Projecting the value. Next point, the projecting the value of a corporate action. Now, why we do this equity valuation also? To understand if there is a particular corporate event that is going to happen. For example, a big thing, a restructuring is going to happen in the organization. A merger is going to happen with some other organization. Some other company is going to acquire you. Some bigger corporate event is going to happen. Then at that point, we also calculate the value of the equity to identify what, suppose if it's a merger and acquisition, then you would try to calculate the value of the equity to understand at what price we should purchase this company, or at what price a merger should happen. So at that point also you do the equity valuation, you find the intrinsic value of the stock. Read that paragraph, projecting the value of the corporate action. Next point, fairness opinion, mark this as star. Fairness opinion. The reason I am highlighting this, because see, whenever a merger and acquisition happens, generally the majority stakeholders take a decision. The minority stakeholders who have very small percentage of share, they might not get an opportunity to put their points. Okay, so if you are a research analyst, you also can calculate the value of the equity as in keeping in mind the minority shareholders. Okay, keeping in mind the minority shareholders, you also calculate the value. That is called as fairness opinion. Lot of these research report, they highlight the normal value of the equity and also the equity valuation as per the minority stakeholder. Right, to read this entire part, fairness opinion. Next section, planning and consulting. So a lot of companies, they also do equity valuation, because if they want to launch a new strategic project, a bigger project, they also want to understand what is going to be the impact on the value of the company. That is the reason they employ equity valuation process, because if they, before running the strategic project and after few months of starting the project, what is the impact on the value of the company. That is why it is called, this is also an interesting component, planning and consulting, where the equity valuation process is used. Right, fairly simple. Let us go towards the next part, communication with analysts and investors. Now obviously, see, when you talk about investors who wish to put money in your company, okay, your management and all, they should always talk in common language. Okay, that is where your equity valuation becomes very important, because I try to identify the current value of the equity, and basis that they can discuss about the future growth of the organization. Right, so that is why this equity valuation process helps them to connect on a single price or single method. Read that paragraph. Further point, valuation of private business. So if it's a public limited company, you can go to the stock market, you can see the current price of the market of the stock. That is easily available because it's a public limited company. But for those private limited companies, you have to employ a equity valuation process, because a lot of those data is not available to normal public. Right, it's a private information. So on the basis of that, you can create a model and you can do the valuation of the company. So that is why also we use the equity valuation process. Read this entire part. I'm trying to talk in a language which is useful for you guys, and also I'm going very slow while reading the content. Valuation of private business. Perfect. Now the next part, portfolio management. Mark this entire portfolio management as star. Okay, now when we talk about portfolio management, okay, the basic function that we want to identify over here is that suppose you already have a portfolio, you want to add a new asset or you want to remove an asset. Then while taking that decision, you would try to understand what is the value of that equity position. Okay, on the basis of which I will decide whether I want to bring it in or I would want to remove it from the portfolio. Right? Obviously, if you have the value, you have the risk also, you will try to take a decision on the basis of that. Now, kindly read the first 3 lines of the paragraph. The first 3 lines. All good? First 3 lines. So it is used, equity valuation is also used in the context of portfolio management. That is what this first 3 line talks about. Now, when you use it in the portfolio management, how exactly are you using? Because when we do portfolio management, the investment is generally done in 3 steps. The first step is planning, execution and evaluation. Planning means the first step, planning. Over here we decide how exactly are we supposed to create the portfolio, what technique we are going to be using. Is it going to be sector specific? Is it going to be a combination of two or three sectors? How are we going to pick up the stock? Okay, so that entire decision of creating the portfolio is done at the planning step. Okay, sometime investor, what they do is they may not go for a particular equity. They might decide on a sector, they might decide on a industry, and they would run a valuation technique on some of the companies within that sector, and basis that they identify which company to pick up for and to bring it in the portfolio. Read this paragraph till here, the first 5 lines of the paragraph. Very simple, right? If it's a passive portfolio, passive investment where I'm directly going to copy the index, then I'm not worried about it. But if it's an active management, actively managed portfolio, then I will have to take conscious decisions which stock to add and which stock to remove. Okay, and when I'm going to do this activity, I will definitely look into the equity value. Right, so over here also your equity valuation process comes into picture, right? Because when I added a stock, it was, for example, undervalued, but now it is overvalued, right? So those kind of changes will always happen. Read this paragraph, the 3 lines which is highlighted on the screen. All good. So this is where we completed the planning step of creating a portfolio. Next is executing the investment plan. Now once we have decided, okay, what should be the structure of the portfolio, which all different securities we should be having, then you go and try to take position in those security. Okay, and obviously the base of this is the valuation methodology. Okay, the base of this is the valuation methodology. Read this, executing the investment plan. Okay, so first you create the investment plan, and then on the basis of this investment plan, you basically go and take the position. Right? Some of the stocks you will buy, some of the stocks you will sell, because you might feel that these stocks are overvalued. You don't want to bring it in the portfolio. Right? I'm taking a quick pause over here. Give me a quick confirmation, guys. Are we guys good on this till this point? Give me a quick confirmation on chat. Give me a quick confirmation on chat. Let us start with the next section. This part will again come in the further chapters there's some concept again repeated in the eco part, where it is talking about the Porter's 5 force model. We call it as Porter's 5 force model. So when I'm analyzing an industry, okay, I will go and do a deep dive into this industry. Okay, and this 5 force model is basically trying to help understand that if you are looking at a stock from a particular industry, is there a particular benefit of being a part of the industry, or a specific disadvantage of being a part of that industry? That is what is being covered over here. Look at the first point, threat of new entrant. Okay, if suppose you are in an industry where the entry is very easy, for example, you starting out telecom, you starting out a telecom company, the entry is not very easy. But if you wish to start out a normal retail store, it is very easy to start, right? In India, right? So entry of barrier makes a big difference, because if suppose you are in an industry which is growing, and if the entry of barrier is very high, then all the benefit you will get. But if the entry to the barrier is very low, then new people will enter and they will do price, they will compete on the price, they will reduce the price, and they will throw away all the growth, all the benefit of the industry. So few of the industry where the entry is very difficult is banking, because you need a license from the RBI, telecom, aircraft, right? Pharma companies, you need huge amount of money to enter and establish your company, right? But those smaller businesses, there are also smaller businesses which is very easy for you to enter and exit. Okay, that is why the the barrier to entry is very, very important. Next is threat of substitute. Now, if suppose you are in an industry where your consumer can easily switch from you and move to a new customer, that is basically your consumer can easily move to the substitute. That is a big risk for you. If suppose you are in an industry where there is no substitute of your product, then you will enjoy high growth and high profit. But if you are in an industry where your competitors or your substitutor is very close to you, for example, Coca-Cola and Pepsi. Now, from a customer perspective, either you will drink Coca-Cola or either you will drink Pepsi. There will be very, very small portion of customers who will only and only loyal to a particular brand. Okay, right? So if the substitute is very strong, it is bad for you. Think about this. Okay, let us go to the bargaining power of the buyer. If the customer has a very, very strong bargaining power, then you might not be able to raise pricing and take benefit of that extra pricing. Okay, because whenever you wish to sell, okay, the bargaining power is with the customer. Now, how does generally the bargaining power comes? If the customer is a big player, if customer if only one customer is doing 70% of your sales, then obviously he will have a bigger say in the price. Right? So that is where the bargaining power of the buyer comes. If there is high bargaining power with the buyer, then you might not be able to make good amount of profit in the industry. Right? If the bargaining power is very low, because the buyers are very scattered and they cannot take the decision. For example, airline industry, whatever price that the aircraft is pitching, you have to take it. You cannot do anything away from it. Right? For example, telecom, you don't have any bargaining power. Right? Whatever is the price that the telecom companies are giving, you have to take it. Right? So that is the bargaining power of the buyer. Bargaining power of supplier. Now, if you are a manufacturer, you are taking some raw material from someone, and if your supplier is having a very, very big bargaining power, then he will try to increase the cost and push the cost on you. Think about this. Before you knew the word Intel, okay, the chipsets which goes into the computer, there was no bargaining power for the supplier. Right? Because their chipset was kind of a commodity. But Intel tried to change it in a different way. They tried to do branding, and they tried to inform the customer that our product Intel is inside this PC. That's where they started running a campaign. The reason they started running a campaign, because customer can now directly identify you. Now you are no longer a commodity, you are a brand, and once you are a brand, you can negotiate properly with the customer. And that is where the Intel started raising their prices and started negotiating better. Simple. Bargaining power of the suppliers. Fifth, rivalry among existing competitors. So if suppose you are one of the telecom companies in India, Airtel, Vodafone, Aircel, Jio, all of this, right? If there is heavy competition between you, obviously you will try to reduce the price and you will try to gain customer. Now in this, if there is heavy rivalry within the competitors, then what is going to happen? Who is going to benefit out of this? The customer, because he is going to get the service at a very low price. Okay, none of the players in the market will benefit out of this. Now why we are looking at all of this? Because if you want to understand what is happening in the industry, that gives you an idea about the growth prospect of the company, and this gives you an idea or help to identify the value of the stock, the intrinsic value of the stock. So Porter's 5 O's model is very, very important. This again will come in the further chapters where we're going to be looking at industry concept. Okay. Now the next part, mark this three pointers as star. 3 pointers as a star. When you are entering an industry, okay, what all strategy you can use to generate market share, to generate profit. Okay, the first is a cost leadership. That means when you enter the market, you break the cost. You give the service at a very, very low price. This is what Jio did. Okay, Jio entered with a free pricing. So they have become a very low cost producer of things. Okay. Now what is happening because of this? Entire market shifted towards Jio and their market price started increasing. The market share started increasing. Right. So this is one way where you can enter the product and you can establish yourself as a cost leadership. When you are saying cost leadership, that means none of the other players are in a position to produce at that particular price. And if you look at this situation, China is doing this in the current market. The manufacturing, electronic, everything comes from China because the cost of production is so cheap over there. Right? Next is product differentiation. You can enter the market by explaining the customer that your product is superior, your product is very, very different. This is what Apple does. When they sell to the customer, they don't sell on price, they sell on the feature, they sell on the future. Right? So that is where your product differentiation becomes very, very, very focused. Okay. These two things you will normally see in the market. Either somebody will enter the market at a lower price or somebody will enter the market at a very, very different product feature. But there is one more part which is focused strategy. That means you will enter the market and you will only cater to a specific segment of the market. Very, very specific segment of the market. For example, in mobile phone, like BlackBerry did. BlackBerry initially was only and only in mobile and only for a business class. So their segment was very clear. They wanted to cater to very specific segment of the market and they wanted to create mobile phone only for them. Okay, so that was a focused approach of entering the market. So these 3 pointers, mark these three points as star. Okay, important for the exam. Read the paragraph, read the pointers. All good? Now once the analyst has identified, okay, this company which I am doing an analysis of, what is the strategy that they're using in the industry? Now once you identify the strategy, it becomes easy for you to identify the future course of action. Because then you can see, okay, on basis of this strategy, what should be the cash flow, what should be the valuation of the company. Read that 2 lines. Fairly simple. Now, the next point, the next paragraph is focused on, it is telling you something very, very simple. See, when you want to do the valuation, majority of the data that you're going to be relying on is basically the data coming from the financial statements of the company. If the company does not disclose any specific information, okay, or the company is not very transparent, okay, then in that case, okay, the quality of information that you are extracting is not good and hence the model that you are creating is also not going to be very, very awesome. Okay, so read this paragraph, the first 3 lines. It tells you that you need to have confidence on the data which you're getting from the financial reports of the company. Fairly simple. First 3 lines. Now, if suppose you're not confident, okay, then obviously you'll have to put in more effort to identify those undisclosed things. You will have to go into the details of the earning, details of the cash flow, details of the balance sheet. So then that will lead to a more time consuming thing, that will lead to more effort from your side to understand what is the true nature or true price of the stock. Okay, that is why the quality of financial information, financial statement information becomes very important for you as an equity analyst. Read that entire paragraph which is highlighted on the screen. All good? An analyst can often only, I'm going to the next paragraph, guys. Now look at this section. Many a times, obviously because of the requirement, you cannot show everything in that balance sheet. You generally have footnotes where the management is giving you some additional information. So you have to be cautious enough, you have to be smart enough to look at those footnotes and try to understand those things which are not explicitly mentioned on the balance sheet. Okay, so because footnote also gives you an idea about the quality of the earning, how much percentage of earning is coming from which segment. Okay, what is the management's belief over a period of time, the quality of earning is going to stay or not. So all of this is generally mentioned in the footnote of the financial statement. So you as an analyst should read that footnote properly. Look at the second paragraph. Right now, why financial statement is can be dicey if the company doesn't want to show you all the information or want to show you only particular type of information, why it becomes a problem. Okay, that is what is being highlighted now. Next, okay, now they have given you few sections. Okay, mark number 1 next to this part. What does it talk about? Accelerating or premature recognition of income. In a very simple, what is happening is, if I want to show that my company is doing very well, what I can do is I can recognize the income of things which are not even happened. That means if suppose I'm billing the customer, normally what happened is that when you customer pays you, then you recognize that income in the books. Okay, but you can also show inflated numbers. Okay, by showing that okay, you've already sold but the goods are at your warehouse, your customer is going to take the good in the next month or next quarter. So that is basically you being very aggressive in showing your income. Okay, now this is a very risky part, because if you realize that the company is doing such a process where they're accelerating or they're recognizing the income way before, because as per the accounting standard, if you find an expense, if you find a loss, okay, you should book it immediately, but you should book revenue only and only when you're sure about it. Okay, so that is why if we are doing acceleration, or basically we are booking the revenue beforehand, that can give you incorrect information about the company's growth. Okay, so look at this first point, which is telling you why relying blindly on a financial statement can be a problematic. Read this entire paragraph and mark this paragraph as star. Mark this paragraph as star. They have also given you an example. Read that section. Okay, recording sales and billing customer before products are shipped or accepted and billed, and hold the scheme in which items are billed in advance and held for further delivery, future delivery. What does it mean? Normally what happened is that customer will order something, he pays, you give him the bill, you dispatch the goods. But if in case you want to show higher sales, you will show that the sale has already happened but the goods are still at your location. This is being very aggressive, because you know the customer will buy, some or the other customer will buy, but after some time. Right, that is one part. That is one aggressive way of increasing. Next is second, reclassifying gain and non-operating income. Now generally when you look at the balance sheet, you have the operating income. In a very plain vanilla simple language, what is operating income? The income that you are getting because of the operations of the business. Non-operating income means peripheral activity. For example, if you have sold a property, that is one-time activity. Okay, that is not an operating income. That's why we call it as a non-operating income. Okay, so what happens is those gains So when you're selling those asset, you might get gain also. Okay, so those things, those gains or non-operating income, you are not showing it as a one-time income, you are actually showing it as an operating income. That is actually this. If the company is doing this, then you will get an incorrect information, and on the basis of that, your entire equity valuation process will fall flat. Right? So read this entire section, the paragraph which is highlighted. All good? You have to think about this very simple, in a very simple language. Certain things, certain income you are getting not because of your normal business, and if you're recognizing it as an operating income, this is going to be a problematic thing, because you are impacting the operating behavior of the company, and also impacting people who are going to take the decision on those numbers. Going towards the next part, expense recognition and losses. Expense recognition and losses. So if the company, for example, okay, if they want to show higher sales, what they can do is they can delay the recognition of expenses. Instead of showing the expense now, they might show the expense after a few months. Okay, so that is where the company can play a very big role in terms of how they are looking at numbers. Mark this paragraph as star. Read the first line. Delaying the recognition of expenses or capitalizing the expense. What is capitalizing the expense? See, if you are showing an expense in the income statement, that means you are recognizing this expense in this financial year. But when you capitalize the expense, you take it to the balance sheet and you spread it across number of years, for 4 years, 5 years, and then you will amortize those expense. Right? So that is a different effect. That will give a different effect. So if suppose some expenses which are normal expenses in a year, but you capitalize those expenses, you took that expenses to the balance sheet. So this year profit will be higher. Right? So classifying those things, so company can manipulate numbers by doing this. Okay, they can also delay the recognition of expense. Instead of showing it in this financial year, you are showing it in next financial year. Okay, that is also possible. Right? If you are suppose highlighting operating expense as a non-operating expense. What is operating expense? When you are running the business, the day-to-day expense is called as operating expense. For example, you have a raw material cost, you have the office rent, all of this. If you are recognizing that expense as a non-operating expense, which is a one-time expense, then you are impacting the numbers in detail. Right? In a simple language, if you are delaying the entire process of getting the expense now, you will increase the sales. If you are being aggressive in showing the expense now, you will reduce the income. Right? Read this paragraph. Read this paragraph. In the last section, they have also talked about debt reserves and provision for the expected litigation losses. Okay, I'll come to that point. Kindly read this paragraph and mark this paragraph as star. Mark this paragraph as star. All good? Now let us go towards the last part. Now management, they have a lot of discretion when they want to identify the bad debt. Okay, when they want to identify, see, what is bad debt? Somebody is a debtor who is supposed to pay you, but he is not paying you because of the XYZ reason. So what is happening is that you have time to recognize this bad debt and write this off. But companies can delay in recognizing that debtor as a bad debt, and they can show higher income. Okay, similarly, the provision for expected litigation losses. If the company recognizes that there might be some losses, but still they are not doing any provision because they know this is going to impact the revenue of the company. That is the discretion available with the management who is running the company. Next part, amortization, depreciation on discount rate. Now this is also important. Mark this entire section as star. Now what it tries to highlight you. Now first of all, I'll go towards depreciation. We know that depreciation is a non-cash expense, and we have seen in level 1 also the depreciation method that is generally there, the diminishing double declining method, right, straight line method. So obviously instead of straight line, if you move toward diminishing or double declining method, then obviously the impact of that expense on a particular financial income statement is going to be very different. Okay, and basis that you will either show higher income or either show lower income. So if you're an analyst, you should be very cautious. Has the company changed the way of calculating the depreciation recently? Right, because as per financial reporting, if you're changing the depreciation methodology, you have to do the retrospective impact also. You have to show that retrospective impact also in many cases. That is depreciation. Okay, amortization, like I said, you are capitalizing an expense, you are taking it to the balance sheet, and what you are doing is you are amortizing it over a period of time. Suppose if I'm a Flipkart, I have lot of marketing expenses because I give lot of goods on at a lower price to my customer. Okay, because I give a lot of discounts to my customer. Now those all are my marketing expenses. I'm not showing those expenses on this income statement. Why? Because I'm taking this to the, I'm capitalizing those expenses, I'm taking it to the balance sheet, and I'm spreading those expenses because I'm going to amortize those expenses over a period of 10 years. So it will smoothen out my expense, right? It will smoothen out on my expense. Discount rate. Now when we are trying to, now over here they have given an example of pension plan obligation. Now what is a pension plan obligation? Suppose if you are providing any pension services or pension fund to your employees, okay, if it's a defined benefit plan means the present value of all the expenses is taken, all the pension payment that you might have to pay after 10 years, 15 years, you take that into account, and you take into account the market value of the invested amount which is contributed by the employee. If the invested amount is lower, then the company has to contribute towards that funda, towards that market, towards that fund. Okay, so over here when we calculate the present value of the liabilities, okay, the discount rate that we are choosing is at the discretion of the management. If discount rate that they are choosing is very different and shows a very incorrect picture, then you will not be able to do the equity valuation in a proper way. Read this entire section, the entire sectional part. In case of a query, kindly put it on the chat section. In case of a query, kindly put it on the chat section and completely read this part: amortization, depreciation and discount rate. Perfect. Now let us move towards the off balance sheet items. Off balance sheet item, this is where this was also there in your asset backed securities chapter in level 1. Okay, where companies create special purpose entity or special purpose vehicle through which they try to create a structured product, they try to sell it in the market, or they basically take position into structured product. Now all of this is generally not shown on your balance sheet, but these things can also act as an asset or liability for the organization. Even the only difference, it is not shown on the balance sheet, it is on an independent entity's balance sheet. Now because there is no transparency, this can give an incorrect picture of the asset and liability of the company to the analyst, and whatever modeling that he is going to use, the model will not be successful. Read this first 3 lines. Read the first 3 lines of that paragraph. All good? Now the last 2 lines. When we talk about finances, okay, we already had seen in the level 1, there was one chapter which specifically talked about leasing. Okay, it can be shown as an operating lease or it can be shown as a financing lease. Now decision of that is also going to impact the balance sheet items. Okay, and that is where your liabilities will get impacted, and this will show you incorrect picture as an analyst. That is why we are talking about this over here. Okay, so we are moving towards now the next learning objective, which is learning objective 24.F. Okay, 24.F. What is the heading? Absolute and relative valuation. What is absolute valuation? I am going to do a valuation of this company only. I am looking at their number. But when I am looking at relative valuation, whatever valuation I am doing for a company, I am going to compare it with some other company's price. That is where I am going to look at relative performance Okay. Now, when we do absolute valuation, obviously we're going to be looking at those models now, which are going to come in your future chapters in equity. Let us look at this first 3 lines, right? Absolute valuation, looking at the investment characteristics, cash flow, risk, and trying to find the value of that investment. First 3 lines. All good, first 3 lines. Now, how exactly can we do this absolute valuation method? The one and first and the very highly talked about method is you discount the present value of the cash flow, and whatever is that present value of the cash flow should ideally be the intrinsic value of that cash flow. This is how you normally calculate the value of majority of the financial assets. Okay, this method is called as dividend discount model. Why dividend? Because we are talking about the equity. Okay, so in equity the cash flow is only dividend. So you will have to project the cash flow for an infinite period of time, take the present value of all the cash flows, and then calculate the value of that equity. Read this section, the next 4 lines, and read it along with me. Perfect. Now, many of the people, definitely within the dividend discount model, there are a lot of other ways through which you can discount it, right? So if you look at this paragraph, okay, this section primarily talks about when we talk about certain, see, for example, it's a preference share. The claim is going to be very different as compared to the ordinary share, right? So the seniority of your claim also makes a big difference in terms of the cash flow that you're going to get. So when you're calculating the dividend discount model, you also need to understand what is the cash flow that we are getting, what is the seniority of the cash flow, and basis that you're going to do the valuation of the product. Read this paragraph, the next 4 lines. Read the paragraph, next 4 lines. All good? Seniority claim, I hope everybody is clear. If it's a bond, for example, then in the bond you have a senior bond, subordinate bond, junior bond. You bifurcate basis the cash flow or basically the claim that they have on the company's asset. Okay, that is the first method that we talked about, discount model. The second method, which under the absolute valuation, is basically asset based model. You try to understand the total asset of the company, you minus the total liability of the company, you come up with the value of the stock or value of the equity, right? That is how this section is understood or this section is calculated. Read this paragraph. If you read it, it will come to know. You'll first calculate the entire value of the asset. Okay, and what is that value of the asset? You'll minus the liability, and then you will come up with that remaining part, which is the true value of that company. Now, this model is generally used for those, since it's an asset based model, it is used for those company where there is some physical asset available, like coal fields, oil fields, right? Some physical thing that is available, which has a great impact on the business. For example, if it's a oil refining company, okay, major revenue is coming from the oil fields that they have control over. So obviously the valuation will depend upon that asset. Read this paragraph. We have individual chapters on these kind of models. Okay, next is relative valuation, where you're comparing with somebody else. Okay, that is the relative valuation method. You're trying to find the value of an asset in comparison with the value of the another asset. Read the first 3 lines. Read the first 3 lines. I hope everybody has read the first three lines. Let us go towards the next section. The most common method when you're comparing it with somebody is basically the multiple method, the price multiple methods, in which one of the best example is P multiples. Okay, you have a list of stocks and you try to understand as compared to the price, as compared to the earning, what is the price that you're paying for that particular asset. That is, you find the P ratio and you compare all of the assets, which are all the stocks which are available, and basis that you try to pick up a stock which has a very low price to earning ratio, which means the as compared to the earning, you are paying very low price for that company. Okay, the most common approach is this, and they have also talked about over here. If the P ratio is very small, that primarily means you should purchase it. Why? Because as compared to the earning, you are giving a very low price. That means it's undervalued. If the P ratio is very high, that means as compared to the earning, you are paying a higher price for that stock. That means it's an overvalued stock. Right? Read this entire paragraph which is highlighted and mark this paragraph as star. Mark this paragraph as star. I hope everybody is done till here. Let us go towards the next section, which is the next learning objective, sum of the part valuation and conglomerate discount. Okay, conglomerate discount. Okay, now what this logically means that if suppose I don't sell my entire company, okay, as a single unit, I break that company and sell it separately. Okay, so that logic is being covered over here. Let us start with the first section. Read this part, the first three lines. If you don't sell the company, you take the individual part of the companies and you basically try to add it up, right? That is called as sum of these part value. Sum of these part value, or also called as breakup value, right? So suppose if I want to value HDFC as a holding company, so it has HDFC Limited, it has HDFC Bank, HDFC Health Insurance, HDFC Life Insurance. So I will individually calculate the value of the company and then add it up to find the value of the entire HDFC brand. Entire HDFC brand. Okay. Now this is generally done when a conglomerate is operating, where a company is operating in different businesses. Okay. Read this entire section. That is where you basically calculate the value of each company and then add it up. But the main thing is that if suppose there are three businesses, okay, the conglomerate value is slightly lower. I'll give you an example. Suppose ITC. Okay, ITC is also into hotels. They are also into FMCG because they also sell biscuits. They are also into books or paper business. They are also into tobacco business. Tobacco is their main business, which is a cash rich business. Okay. Now, if you want to do the valuation of these four businesses to come up with the value of this conglomerate. Now, why am I referring it as conglomerate? Because it is operating in so many different businesses, not correlated to anything, right? So suppose if this is 100, okay, this is 100, this is 100, and this is 100, just for an example purpose. When I go and calculate this value of this conglomerate, it will ideally be less than 400. Say for example, it will be like 385. Why this situation is happening? Why this situation is happening? Because generally investors, they add a discount to a conglomerate. Okay, that is what is referred over here as conglomerate discount. Why? Because companies who are operating in different business where there is no connection over here, they might be very slow in decision making because they are into unrelated businesses, right? So the value of the company should ideally be slightly lower as compared to the addition of all the four or all the part, because the decision making is going to be very slow. The economy of scale they might not get. Okay, and the speed of the company will be slightly lower. That is why the investors generally give a conglomerate discount. They will not rate the price of the ITC at 400, but instead of that they will rate it at a slightly lower, which is 380. Okay, now why do we find such kind of a discount? Why there is a markdown on the value, which is a equal of all the 4 points? Why there is a markdown? Okay, this is these are the three explanations that we see. Mark these three explanations as star. First reason being internal capital inefficiency. Why? Because we are operating in different businesses, the capital allocation will be very slow. Okay, very slow, because within each businesses there are so many different departments. Okay, it might be possible that the company might take a lot of incorrect decisions while employing their capital. That is one reason. Second is that endogenous factor. When you are operating in so many different businesses, so many different unrelated businesses, the risk of that one particular business is also going to impact you. For example, tomorrow ITC's tobacco business is closed because of the government regulation, then it will definitely have an impact on the entire ITC group, right? So their poor performance from one business will impact the business of the other unrelated companies also. Okay, because they are all interrelated through a conglomerate. That is called as endogenous factor. If suppose tomorrow ITC, which is having a huge cash coming from tobacco, they use that cash flow to buy a new company, right? This is where your external decision makings are impacting your particular business, right? This was the second point. Third point, research measurement error. Now why do we generally see conglomerate discount? Okay, it is generally said that okay, there is no such thing as conglomerate discount. It might be primarily because of the error in the valuation of the entire company. Okay, so the third explanation is that why do we see when we go and independently value ITC, why do we find 385 not 400? It is primarily because when you're valuing independently ITC, you might have done some error, and because of which you are finding a lower value. There is no such thing as conglomerate discount. That is the third reason. Read the thing. All the 3 pointers, very important. Mark it a star. You can expect a question in the exam on this topic. All good? Let us go towards the last learning objective. Okay, over here the section primarily talks about that if the analyst is planning to use a model, how should he decide which valuation model to use? Okay, so first he will go and try to understand which company we want to value, what is the business of that company, what is the characteristics of that company. Okay, suppose if there is a company which does not pay any dividend, it's a growth company, then why would you use dividend discount model? You will not use it, right? Simple. If the company is not very asset specific, then you cannot use an asset model. So on the basis of the characteristics of the business, your model is actually chosen. That is the first point. Second point, okay, we also will take into account how much information is available with respect to the company and what is the quality of that information, right? And because if the information is freely available, you can easily calculate the dividend discount model. But if it is not, then you might have to use some other methodology like the price multiple model to come up with some number, right? And the final and the third point is that why am I doing this analysis? What is the purpose? Is the purpose to acquire the company? Is the purpose to go and understand the bigger market events that is going to happen, right? Or is it only taking a minority stake? So what is the purpose of the analysis also dictates which model I'm going to be using. Read these 3 lines. Guys. Right? I hope everybody has read the first 3 lines. Now in that 3 lines, the last part, the purpose, we are going to be reading about this now over here. What is the purpose of your analysis? Is the purpose to make a purchase offer for a company, right? Or is it only to understand, only to take a minority interest in that company? Okay, now the reason we are talking about purchase part, or basically getting a controlling interest in the company, because on the basis of controlling interest, you can control the dividend policy of that company. Because if suppose you have majority stakeholder in the company, if you are a majority stakeholder in a company, then you can decide how much dividend that the company should pay. You have the voting right also, right, on that. So that is where this factor come into picture, this paragraph. Read that entire paragraph. Right? Finally, the last note. Finally, the last note which we can see over here is that what generally analysts do is they try to calculate the value of the equity not using only one model. They use 2-3 models so that they can compare and question why in a particular model the price is coming lower, why in a particular model the price is coming higher. Right? To read this paragraph, read this entire paragraph, it tells you that we're going to be doing analysis using 2-3 different models. Right? Give me a quick confirmation, guys. Are we guys good till this paragraph? Give me a quick confirmation on chat. Have we been able to understand the logic of this chapter? It's a very small chapter, theory chapter. You can expect one question to come from this chapter. And primarily, I feel that it's going to be related to intrinsic value logic only. Okay, let us go and solve the questions which we see over here. The first question, okay, Suzanne is basically noted that even our best estimate of a stock's intrinsic value can differ significantly from the current market price. The least likely explanation. Read the options properly. The least likely explanation. We read about two parts, right? One was the actual mispricing and second was the valuation error. What was the actual mispricing? The actual intrinsic value and the difference between the price. That is the actual mispricing. Okay, right? That is actually referred over here. What was the second method? Which was your valuation error. So that is your intrinsic value and the actual intrinsic value, right? That is being referred over here in A. So your answer has to be C because we have not seen anything related to going concern. So answer for the first question is C. Fairly simple. I would request you guys to start posting the answers also on the chat. Let us go to the second part. An appropriate valuation approach for a company that is going out of business would be to calculate what? What is the answer for the second one? Kindly post your answer as 2.A, 2.B, like that. If the company is going out of business, what value should we look at? Yes, it should be liquidation value. Right? Because see, you cannot use dividend discount model because dividend discount model is based on the future cash flow. Right? Residual income is basically whatever is the cash flow that you are getting, you are removing, you are seeing what is the value add and what is the leftover income, then you are calculating. That is one more method that we will be seeing in the future. The answer for over here is C. Let us go towards the third question. Third question. Okay. So Devi is performing equity valuation as a part of the planning and execution phase of the portfolio management process. His result will be useful for what? Now this is slightly different question. When he is doing an equity valuation for planning and execution of the portfolio, his result will be used for which of the following purpose? Come on guys. Is it going to be used for technical analysis? No, because technical analysis uses the previous market price of the stock. So that is gone. B is not there. Benchmarking. See, benchmarking is used only when you want to compare things. The answer for this is A. Communicating with the analyst and the investor, right? Look at the option. Yes, the third one. Krishna, kindly check the answer. Let us go to the fourth point. The 5 element of industry structure, which is the Porter's 5 force model. Which of the following element was there in that 5 force model? Entry barrier, supplier, bargaining power of supplier, bargaining power of customer, right? Threat of substitute. There was one more. Yes. So what is the answer? Answer is A for the fourth question. Right? This product differentiation, cost differentiation is basically the strategy that you are using when you are entering the market. Right? Let us go towards the fifth question. Tom Walder has been instructed to use absolute valuation model and not relative in analysis. Which of the following is least likely to be an example of absolute? Least likely. This is fairly simple. So when you do absolute valuation, you only look at into that company. So you look at the dividend of the company, you look at the residual income of that company, but you don't look at the price to earning, because price to earning is what? Price to earning is a relative valuation approach. The answer for this is B. Let us go towards 6. Devi is performing an equity valuation. And review his notes for key points he wanted to cover. He saw 3 pointers. Does the company pay dividend? Is the earning growth estimate? Does the company have significant intangible asset? Which of the following question he wants to answer? Come on, guys. Why is he looking at the dividend model? Why is he looking at the growth estimate? What should be the answer? Why is he asking this question? Right? Yes, the answer is A, because he wants to understand which model to use. What is the characteristics of the investment? So basis that he can decide which model will fit my investment analysis. The answer for this 6th question is A. You would remember these 3 pointers we saw in the last part of the chapter. Let us go toward this next part and mark this question as star. Similar type of question will be expected in the exam. Question number 7 and 8. Question number 7 and 8. Sun Pharma, which is a large pharmaceutical company. Now this is based out of Sri Lanka. Okay, they are manufacturing some drug. Okay, and their CEO is planning to purchase a different company altogether, Island Cookware. Do you realize this is not in his business? This is an unrelated business. Okay, which is producing cooking utensils. Okay, now he feels that the Cookware Island network is very good, and they can sell their Sun Pharma products through the distribution network of Island Cookware. And several days later, they realize that Sun Pharma has acquired that company. Now the first question, which is the most appropriate valuation methodology that they should have when they are trying to value the company Island Cookware? Come on, guys. 7th question. What is the answer? 7th question. See, Sun Pharma is doing an investment in the company. So when they are taking position in the Island Cookware, they would ideally be taking, yes, the investment value. This is what we read in the previous section. So 7th question is B, investment value. Fairly simple. It should not be sum of the part, right? It cannot be liquidation because the company is not getting closed. It has to be investment value. Let us go to the 8th question. What do you think is the value of that 8th question? Upon announcement of the merger, the market price of the Sun Pharma drops. The most likely reason for this drop is what? This is very, very simple and straightforward. We have read in this section. What is the answer for the 8th question? The reason the price is dropping because of the conglomerate discount. Why? Because the question that they had given you, they know that the Sun Pharma was in the pharmaceutical business, but they are acquiring an unrelated business, which is why the total value of that Sun Pharma after the acquisition is basically going to be reduced. That is because of the conglomerate discount. Simple, fairly simple, right? Give me a final confirmation, guys. Now, do we have the confidence on this chapter? When the questions will come, will we be able to solve this question or not? Give me a quick confirmation on chat. Right? So perfect. Thank you very much, guys, for joining in. We are going to be starting out with a batch for CFA Level 2 students, and we are planning to start in such a way that every day you study, you prepare for the exam, because for November it's a very small time. Again, you have around 4 months, full months to prepare and complete everything. And in that batch, we are also planning to keep separate time for solving the end of the chapter questions. Okay, so in case if anybody is interested to join the batch, they can WhatsApp on the number which is given in the description of this video, and they can reach out to us and we'll give you the details about the batch which we're going to be starting out for CFA Level 2. Okay, so thank you very much, guys, for joining in. We will be keeping up few more sessions in the future, and kindly subscribe to our YouTube channel, because over there if you join, then obviously you'll come to know whenever I come live and also whenever I'm posting new topics for the session, right? So thank you very much guys for joining in.